Hello there and welcome. I'm Tushar Chande. Are you new to technical analysis and do you want to get better? You found the right video. You see all those indicators there in the blue box below? I've invented every single one of them and a whole lot more. And my indicators are very popular. I'm going to talk today about introduction to exit strategies and trailing stops. So if that's a topic that interests you, yeah, I can help you with that. Just a quick reminder that past performance is not necessarily indicative of future results. So philosophically, the question is, why do we need an exit strategy? Why do we need a trailing stop? And the answer is because we don't know the duration or the amplitude of a trend. So if once a trade starts, we don't know how long it might last or how far it may go up or down in terms of the units on the y-axis. And that's why we need some sort of trade plan to get us out of the trade. And let me give you an example of that. So this is how we can classify exit strategies. We have three columns: what we don't know about the trend, how we can solve it by making an assumption, and how we can implement it using a particular type of order. So let's say we don't know what the duration is going to be. So we can make an assumption and say we'll exit after 5 days or X days. And we could implement that with a market order or a market on close order, for example. Now, we don't know the amplitude of the trend, so we can specify a profit target either in percentage or in units of the underlying contract specification, and we could exit with a limit order. Again, if we don't know the amplitude and the trade goes against us, we can use an initial risk stop or a dollar stop, and we can implement that with a stop loss order. And finally, if we don't know the duration or the amplitude, then there's nothing we can assume, and we can simply use a trailing stop, which is below prices for long trades and above prices for short trades, and we can implement that with a stop order. So that's how exit strategies can be classified. So this is an example of a well-behaved trend. You see prices were declining, then they stabilized and declined again. And then this is an example of a volatility-based trailing stop, and you see that the stop was above the prices because this was a short trade, or you were betting on prices getting lower. And essentially what you would do is every day you would enter, please get me out of this stop or this stop or that stop and that stop and so on. And you're waiting for the prices to reverse and go through your stop, in other words, hit your stop. And that would be how you'd exit the trade. Now, not all trades are so well behaved, or not all trends move as smoothly as this one. So this chart illustrates a common problem with setting stops. The chart shows Tesla having a gigantic move in the middle of the chart. And if you look at the 20-day channel, the highest high of 20 days and the lowest low of the 20 days, the range between the two expanded dramatically. So let's say our stop was here. Somehow we'd like it to end up somewhere there so that we could capture more of the equity in the trade. And let me show you how that can be done. So this is an example of implementing a accelerating trailing stop using the adaptive moving average called VIDYA, which stands for Variable Index Dynamic Average. And you can see that as Tesla was rallying rapidly here, the trailing stop also moved up aggressively and would have exited within a few days of the absolute high of the move, which is about as good as any trailing stop can do for you. This is the Tesla chart again, but with the volatility trailing stop. The volatility trailing stop uses the recent high and subtracts a fixed amount from it based on the volatility of the underlying market. So you can see that here the volatility stop was pretty far away from prices, and then it accelerated nicely to again give an exit relatively close to the absolute high of the move. So this is another example of a rapidly accelerating stop exit that accelerates based on price action. And this is another type of channel exit, but I'm using a relatively shorter channel with a delay to give us a little more flexibility on when we can get out. And you can see that this is the same Tesla move that we've been following, and the exit here was not too far from the absolute high of the move in terms of time, but still a bit lower than the accelerating exits. So this is another option of using a type of exit strategy. This is an even more aggressive trading strategy called the Parabolic SAR, or stop and reverse. The red dots again show you that this accelerates very well to get you an exit that's very close to the top of the trade. There are two problems with this strategy. It's very active, so you might have encountered exits earlier in the process. And the other problem is that the long trades and the short trades get implemented the same way. So if we could split the short trades from the long trades and have more control on where it starts and how it accelerates, then you could get a really nice exit strategy. And I'll show you how that can be done. So this is my solution on the parabolic side using the chase of the Chande Accelerating Stop Exit. The starting point is set here and can be easily controlled. I've chosen the 20-day channel as a starting point. So it's starting at the 20-day low. You can set the accelerating speed to 4 default speeds or almost anything else you want. So you see the green dots and the red dots are moving at different speed. And of course, we don't know what the optimal speed is going to be. So you have to choose one and stick with it. And you see that in some instances like this, it works very, very well. And in some instances, it's maybe just okay. And that's always a problem with any stop. This is the chase exit, the Chande Accelerating Stop Exit on the short side trades. They again start from the 20 bar channel, but you could pick any channel you want. And I've shown you two speeds with the red dots and the green dots. Again, you have flexibility on speed. And if you look at this particular down move, the red dots gave an exit closer to the low than the green dots did. But if you look at this leg down, the green dots gave an exit that was closer to the ultimate low than the red dots did. So we don't know what the right speed is going to be, but that's part of the challenge. But the beauty of what we've done here is that we can separate the long trades from the short trades. We can control where they begin with the chase exit, and you have a lot of flexibility on setting the speed and the acceleration, that is the ramp up of how the stop works. This is an example of applying the volatility exit to the corn futures contract. You see that we had a strong move up here, and the volatility stop accelerated and gave us an exit within a few days of the absolute high of the move. So this is an example of how the accelerating exit can adapt to the volatility of virtually any market you want to trade. This is the volatility stop applied to the yen-dollar cross rates. We're plotting Japanese yen to the dollar. As rates started to rise in the US, the yen started to weaken or the dollar started to strengthen. And you see that the trailing stop worked very well as it accelerated up also with the prices. An interesting feature of this particular strategy is that it backed off a little bit as the market dropped down slowly, so that when the trend continued, you'd still have been long and you could stick with the trade for a longer time. So each strategy has its own strengths and weaknesses. So on this chart, I've shown you three exit strategies that we have seen so far. This is a chart for EQT Corp, which is an energy company. It started to rally when the energy market itself rallied, and now you can see the three stop strategies on the same chart. The blue line is the delay channel exit. The dashed orange line is the adaptive moving average VIDYA with the setting at 1010, and the red dots are the volatility stop exit. So if you look at this move up here, you see that you might have been tripped by VIDYA here, but your exit there was pretty much in line with the volatility exit. The delay channel exit was the slowest for this particular move, and for this leg up, the delay channel and the VIDYA gave approximately the same exit, but the dotted line of the volatility stop is pretty far away. So this is an example to show you that the strategies have different underlying mechanisms. They respond differently, and it's really hard to know a priori what the right stop strategy is going to be for any particular trade. So that's part of the challenge. You can either try to adapt it as you go along, or you can pick one strategy and stick with it. Or you can use all three and pick the stop that's closest to the price at any given moment. A gentle reminder, the stops only work if you enter them with your broker. And remember, there's something called slippage, which is the difference between the price you would like to get and the price you actually get. But if you trade a lot and you average this over a lot of trades, you can get a pretty good feel for how each exit strategy is contributing to slippage. The Tushar Chande's complete toolkit for Metastock has the VIDYA moving average, the volatility stop, and the delay channel stop that I've showed you during this presentation. And this package also has a number of other interesting features and systems. Overall, it's very easy to use, and you can use it on any time frame, and you can use it in any market, any exchange, any type of market condition. So you can get it at metastock.com/Chande. So my package for NinjaTrader that you can get at chandeindicators.com has the chase accelerating exits and a few other goodies that you might find useful. Thank you so much for staying all the way to the end of the slide deck. You can visit me at chandeindicators.substack.com for my blog. Until I see you next time, have a great day.